Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. Equity markets across the Asia-Pacific are advancing despite some weakness in the U.S., and today, a lot of focus on Japan because Monday we had the BOJ Governor Ueda talking up the prospect for a rate hike. Money markets now suggest an 80% probability of the BOJ raising its policy rate on December 19th. Just a week ago, that probability was below 25%. And speaking of central banks, we've got the Fed's decision on December 10th. Now, we know that EM stocks and currencies have been benefiting from expectations for a Fed rate cut. For a closer look now at EM, I'm joined by Joy Young. She is head of product management and marketing at MarketVector Indexes. Joy joining from just outside of New York City. Thank you for making time to chat with me. We know that EM equities, generally speaking, are on track for their best year since about 2016, I think. And it's interesting that these gains have occurred against a backdrop of not only higher tariffs, but a struggling Chinese economy. How do you make sense of that?
I think one, it's an emerging market, so there are risks, whether it's to data or individual companies, but not all companies within China are uninvestable, which is where we had started probably at the end of last year until we saw that, these are companies that benefit from AI, and we see that in Alibaba and Tencent. And these are also companies that are participating in the same growth stories that are driving developed markets, such as gold. Gold miners in China have done extremely well. So investors have to look carefully, not just at the country, but the themes within the country. And even China is an interesting case because when investors consider China, we're seeing a lot of domestic Chinese stocks now listed in Hong Kong. So, you should include these Hong Kong listed names that are exposed to domestic Chinese economics. So, whether that's good or bad.
So that's the trade, essentially. Maybe you focus on things like artificial intelligence or robotics in terms of the Chinese equity market, but you avoid things with a lot of exposure to domestic demand, which, as we know, has been stalling. And the housing market at the same time remains under duress.
Yeah, essentially, these are the risks that you're taking in emerging market, whether it's China or even India. And we saw India again in 2024 had just the superb outperformance, and it's looking expensive now. But within India, digital economy is doing well. And so we think that investors, should focus within India on things like digital economy and infrastructure.
So we mentioned artificial intelligence as it relates to China, but as you well know, the intricacies of the supply chain, whether you're talking about high bandwidth memory chips or the chips that NVIDIA produces manufactured by TSMC in Taiwan, a lot of the raw materials that are necessary to produce those semiconductors, all of this is very interrelated, and I'm wondering how you're approaching that right now, whether you're looking at markets like Taiwan, like South Korea, as a way to leverage that AI trade.
Absolutely. So I think if you think about emerging markets as a whole was kind of written off, people were under allocating to emerging markets, so they had higher risk premiums because, most investors thought that they would be negatively impacted by the tariffs. But as we know, these tariffs still have, a lot of noise in there. There's been taco, strategies and reversals in tariffs. And we've seen that emerging markets in aggregate have adapted really well to the tariff noise because they've been able to either pivot away from some of the noise by trading towards China or the rest of the world. And they have also been beneficiaries from the rest of the world trying to pivot away from the US. And that includes, countries like Taiwan, which is still a significant part of the AI story, as well as Korea. And Korea is another interesting case where at the beginning of the year, we were talking about martial law and a crisis in the government. So a lot of people shied away from Korean markets. Year to date, Korea is the highest performing country in the market. So I think investors have to be constantly reassessing, repricing the risks that they've placed in some of these countries.
I'm curious about Vietnam. Right now, the country seems to be on the cusp of being a frontier market, maybe early stage EM. How do you look at Vietnam these days?
I think Vietnam is also another one of these growth stories, not just on the back of fundamentals because they've restructured their debt and they've invested in the infrastructure. They're also beneficiaries of the China alternative manufacturing story. But again, as you mentioned, they're on the verge of graduating from frontier market to emerging market status. And that's going to be a benefit with trade shifts and allocations towards, this country coming into the broad emerging market class. And again, this is kind of the overall emerging market story is that, some of these countries and both equities and bonds have, seeing really good restructurings and financial discipline to the point that some of these debt are even better than their developed market counterparts. And, we're seeing now they're the adults in the room given the high level of debt in developed markets.
I'm so glad you brought up the debt side of the story because I'm wondering how you feel about EM debt or EM credit, broadly speaking.
At the moment, and again, not all emerging markets are the same, but at the moment, there are some really high quality emerging market country debt because they've been restructuring and improving over the years. They've really brought their debt levels down, relative to what we're seeing in developed markets. And they're benefiting from the dollar weakness because their borrowing costs are also shrinking.
So, Joy, you pointed out that it has been a pretty good year for EM, broadly speaking. And I'm wondering whether it would be prudent now in the final month of the year to take a little bit of risk off the table. Is this a time to de-risk, do you think?
Well, essentially, everybody seems to be de-risking at the moment, given the volatility, increase in volatility that we're seeing. But I think, again, investors think in terms of calendar year, but you really have to take a longer view when you're thinking about your strategic allocation. In terms of de-risking itself, depending on what your portfolio shape looks like. But I think investors are also, when they take a broader, longer term view, markets are still, like we talked about markets coming down today, but markets are still trending up. It's up 16-17% year to date. And this is on the back of two strong, over 20% return years. And it's very unusual to see 3 strong years in a row with volatility so low. So, one of two things has to happen. Either returns have to come down or volatility needs to go up. And if that's the case, you have to readjust your own position given your risk tolerance.
Does it suggest to you in any way that what you've just described is an illustration that there is still ample liquidity in the system and what we are seeing in price action may be a reflection of that?
I think it's a reflection of the nervousness in the markets as they're waking up to the fact that they may, not have priced in the full picture of the risks that are in some of these assets. AI, NVIDIA, these are all risky assets, as well as Bitcoin. So investors need to really understand what their risk tolerance is and what they're pricing in to some of these companies they're invested in.
Joy, we'll leave it there. Always a pleasure. Thank you so very much. Joy Young is Head of Product Management and Marketing at MarketVector Indexes. Joy joining from just outside of New York City here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. Bit of uneasiness seemed to grip the U.S. equity market in the last session thanks to a sell-off in cryptocurrencies. We had Bitcoin dropping more than 6% in New York trading to around 85,000. And that decline forced liquidation of nearly $1 billion of leveraged crypto positioning. For a closer look at the price action, I'm joined by Tim Pagliara. He is founder, chairman, and also the CIO at CapWealth. Tim joining from just outside of Nashville, Tennessee. Tim, thank you so much for joining us. I'd like to begin by getting your take on the correlation between crypto and certain pockets in the equity market that may be described as a little riskier.
You know, it's really hard to say, Doug. I mean, there's lots of rumors about, the impact that tightening regulations in China and Asia are having in general on crypto. It's a risk-off trade. Bill Ackman suggested last week that it potentially is some deleveraging, margin-type calls. People that have been attracted to crypto in one sense have been leveraged into some of these other names. And, when it all starts collapsing, so to speak, that's what happens when you get a broad sell-off in an asset like that.
We also had a backup in yields today right across the Treasury curve, more so at the long end. This seemed to be tied to a little bit of volatility in the Japanese debt market overnight. 2-year borrowing cost on the short end of the curve in Japan jumped above 1% for the first time in 17 years. So it seems as though the market is now better prepared for the possibility that the Bank of Japan is going to hike interest rates maybe as soon as this month. We'll have to wait and see. But when you look at the Treasury market here in the U.S., how does it appear to you, particularly as we've got a Fed decision less than 2 weeks away?
Well, I think it's, our Treasury market is stable. As we all know, the Fed doesn't control the long end of the curve, but they can impact the short end of the curve. What you mentioned about Japan is interesting, and it's part of a much bigger problem because they're having to unwind a trade that has worked for a number of years where, in Japan, they essentially have a tax on their pension funds because their pension funds are required to own Japanese securities. And so they set that rate it's been at a very, very low rate for years and years. And then they created an arbitrage by buying U.S. treasuries. So they were making a spread and financing their deficit. So their deficit, they're off the charts. It's 200% of GDP. And so that's a situation that we watch very closely, and how much the Japanese economy can absorb with higher rates now that inflation is back and their deflationary spiral has stopped is something of significant concern on a macro global basis.
So I mentioned the Fed decision. That happens on December 10th. This Friday, we're going to get the Fed's preferred measure of inflation, the PCE reading. It's expected to show, at least if you look at the Bloomberg survey, that inflationary pressures may be stable, but they're still sticky and above that 2% target. Do you think it's a foregone conclusion that we're going to get a quarter-point cut in rates?
I think we'll get this quarter-point cut, and then after that, I think it is wait and see. They'll get more data. There's a lot of indications, for example, with auto loan delinquencies, rising inventories among the car manufacturers, other things that would suggest that the employment situation is slowing and would justify some type of move on the Fed's part. The other thing that's important, I'm looking at not so much interest rates, but the money supply. And, the quantitative tightening really needs to stop because we're in an artificial intelligence war, a build out that's going to take trillions of dollars. And so we're not even halfway through that. And so it's almost a national security issue at this point that we're allowed to finish that and then deal with some of the fallout that inevitably comes from one of these boom and bust cycles.
Yeah, we had another deal in the AI space today. NVIDIA investing about $2 billion in the chip design software maker Synopsys. Where are you right now in this AI trade? Do you think it's still viable? Are we maybe wrong in expecting some type of moderation or a pullback here, at least in the near term?
Well, it's very difficult when you look at the amount of money that's going to be invested. One of the firms put out an article about $7 trillion in AI spending would suggest that you need $1.5 trillion worth of profit to support that. And that becomes very problematic. If you took all the dividends and all the stock buybacks of the Mag 7 and you stopped them, that gets you just under $600 billion. So there's a lot of money that has to flow into that space and complete it. Our favorite name, and we classify it as a deep value name in AI relative to everything else, is a company called Lumen. Once these hyperscalers are in full operation and they're moving data, the existing network is not fast enough. It's not secure enough. It needs tremendous build out. And there's over 1,000 hyperscalers that have adopted Lumen, and they have the largest independent fiber network basically in the country, possibly the world right now. All of these hyperscalers are going to have to connect. They move data at 400 megabytes per second. In your home, you're moving data at 400 megabits per second. So Lumen transmits data between these centers 8 times faster than what you can get in your home. And that's what's going to be necessary to really support this. It's the train tracks of moving data between these big centers.
As I'm listening to you, I'm wondering whether or not a company like Lumen would use artificial intelligence to manage the network.
Absolutely. In fact, they entered into an agreement with Palantir. Alex Karp and Kate Johnson were in an interview recently, and Alex Karp called Lumen the backbone of the AI revolution. So it just naturally follows, and we've been consistent about this, you go from chips to the applications and the software applications, but then you've got to be able to move that data. You've got to move it at a commercially reasonable pace. It has to be secure. Lumen has security provisions between these centers that are gaining widespread adoption. In fact, Microsoft last week announced that they were going to use their Defender offering to bolster internet security. Microsoft has been in an agreement with them. They entered into it over 2 years ago. Corning entered into an agreement with Lumen 2 years ago to provide Lumen with 10% of all the fiber they could produce over the 2 to 3 year period. So there's more coming, and like I said, we got to finish it. It's like a subdivision with homes. They've been on temporary power. They've been on temporary water and sewer. They get their occupancy permit. Now they have to be lit up. And that's what's going to happen over the next 12 months to 3 years. And all of a sudden, it's going to be a big issue. And I think the market's recognizing that.
So, Tim, you and I both know that December is historically a very good month for the equity market. First day of trading here, we were negative across the board. Does that cause you maybe to take a breath and to say, I'm wondering about how we're going to finish the month of December? Will we get a Santa Claus rally here? How are you feeling about equities going into the end of the year?
Well, I think the Federal Reserve will help, with a rate cut. But I don't think that will, be enough stimulus. I think what's happening right now in the market, I think, is very, very healthy because people are asking questions finally. You've seen a company like Oklo, who admittedly they have a a bright future in providing, small reactor nuclear power to meet electricity demands, but they don't even have a system operational yet. They're still roughly on the drawing board, and it got up to over $22 billion worth of market cap. No earnings, no revenue, nothing. So I think you're going to continue to see companies like that pare back as some of the speculative aspect of the market, starts to wind back down. So I think it's healthy. Yeah, we may not, get what everybody wants in terms of a Santa Claus rally. My view is that the market will be very muted between now and year end.
Tim, we'll leave it there. Always a pleasure. Thank you so very much. And if I don't speak to you before then, happy holidays. Tim Pagliara is founder, chairman, and CIO at CapWealth, joining from just outside Nashville, Tennessee, here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.